So today I wanted to talk about taxation and the super-rich, and many of you will remember 5 years ago when Thomas Piketty wrote his book Capital in the 21st Century, made it quite a splash, and since then in many countries there have been discussions about inequality and also tax justice. Most recently, for instance, here at the World Economic Forum in January in Davos, the historian Rutger Bregman got a lot of attention with his call to the audience on one of the panels discussing inequality. We've got to talk about taxes, taxes, taxes. And I think there's hardly a better time than now to talk about this. Because in the US, in fact, a lot of recent new proposals have been put forward, especially on the democratic side of the political spectrum. For instance, Alexandria Ocasio-Cortez, AOC, as she's usually referred to, newly elected Congress representative, but for some reasons immediately very prominent, especially with the younger voters, has proposed a new income tax bracket of 70% marginal income tax on all incomes in excess of $10 million per year. And even more prominently, US Senator Elizabeth Warren, who is one of the presidential candidates for next year's presidential elections in the US, has proposed a new annual wealth tax of 2% on all wealth in excess of $50 million and 3% on wealth above $1 billion. And since then, Bernie Sanders, another presidential candidate, has proposed an even more progressive wealth tax, up to 8% annual wealth tax on people who own more than $10 billion. So that's literally just talking about roughly 50 people in the world. So I think this discussion is quite heated at the moment, at least in the US, and it will stay like that. That's my prediction, at least until next year when the elections are going to happen. And the experience tells us that then, if this is really a big topic in the US, at some point it's going to sweep back to Europe. Now, where is this all coming from? So this is a picture that many of you have probably seen already. It shows the trends in income concentration over the last 40 years. So what you see here is the share of total income in the US going to just the top 1% of highest earners and the bottom 50%. And whenever I show this to my students, what's quite striking about these lines in the first place is that they fit on the same scale. Even though, by definition, of course, the bottom 50%, that's 50 times more people than the top 1%. And you see this dramatic increase in the share of total income going to just the top 1%. It's more than doubled from about 10% in the 70s to now closer to 25%. And at the same time, the share of the bottom 50% has continuously decreased. Now, often we think of Switzerland as a haven of stability that is quite insulated from these trends. And when you look at income distribution, that's indeed true. So here I'm plotting the same picture for the Swiss income distribution. And it looks very different. In fact, it looks much closer to what you would expect it to be. You know, the share of going to the bottom 50% is always much higher than going to the top 1%. You see a little bit of an increase going to the top 1%. In recent years, it has increased from about 8% to 12%. But all these trends are much more muted and the levels are much less concentrated. So it is true, looking at the income distribution, that Switzerland is remarkably equal and seems to be doing a good job in keeping inequality in check. Now, a lot of the recent proposals have been more targeted at wealth inequality rather than income inequality. And I think that discussion, the Warren and Sanders proposals in the US have been largely driven by the dramatic increase in wealth inequality that we've seen. And whenever we look at the wealth distribution, one thing to immediately note is that it is much more unequal than the income distribution. Everything is much more concentrated when it comes to wealth compared to income. Here, again, you see the top 1% share of total US wealth. And you see I'm not even plotting the bottom 50% share because it would be zero, so you wouldn't see it. So the bottom 50% have roughly zero wealth. The median wealth is very low in the US. And the top 1% share has increased again, almost doubled, and the concentration is almost twice as high as for income. Remember, the top 1% share for income was about 20 to 25% for wealth. It's just the 1% richest people own almost half of the total wealth in the US. And here is, that is an example where, in fact, Switzerland is not that different from the US. So the Swiss data is a bit less extensive. So you see some holes there in the time series, and you see that it started already from rather high levels, even in the early 80s. But if you look at the recent concentration, again, that's the top 1% wealth share, it reaches similar numbers. About 40% of total wealth are owned by the top 1% in Switzerland. And of course, there's another specialty in Switzerland, which is that here we have a pension system that is based on savings. So a lot of us have, these second pillar pension accounts where we accumulate a lot of savings. Even middle class people have a lot of wealth there. That's not included here in this data. So if you did that, and that's not so easy because you don't see that on tax returns, this is wealth that is not subject to the wealth tax, then these numbers go down a little bit, but not dramatically. So you would still see an increase in concentration, and in international comparison, in terms of wealth inequality, Switzerland would still feature relatively high concentration. Now, I want to focus here a little bit on the very top of the wealth distribution, because as you've seen, the Sanders proposals in particular, but also the Warren proposal, have been targeted at essentially billionaires. If you own more than $1 billion, you have to pay this 3% tax rate, and for Sanders, it goes up to $10 billion with a progressive tax schedule. And what we're doing here is just looking at the 400 richest people in the US. So this is a list put together by the Forbes magazine. So those are journalists that do sort of through investigative reporting, try to put together these numbers, how much these people really earn. And the Forbes magazine yearly produces this new list of the wealthiest Americans. And you see that they've been doing also remarkably well. So just these 400 people used to have about 1% of the total wealth in the US, and now it's closer to 3.5% of the total wealth. And I think that is also driving some of the discussion about what that wealth really means and whether our current tax system is really doing a good job in addressing these super rich people. Now, the beauty of the Forbes 400 is that it's very detailed. You can really see exactly who is there. We have the list of names, and they collect a lot of other variables. So what I'm showing you here, we can sort of ask, who are these people? Where is their wealth coming from? And I should say, much of what I'm showing you here is from a recent paper that I just wrote last summer together with Joel Slemrod from the University of Michigan, where we did this analysis. So it's a paper with the same title as this lecture today. And what you see here is quite some changes in the composition of industries that these Forbes 400 had their businesses in. So in the 80s, maybe unsurprisingly, there was a big share of these rich people in the energy and mining sector. If you think about the Texas oil tycoons, for instance. Real estate was important. Think about people like Donald Trump. And that has shifted quite a bit. Most recently, the most recent data we have from last year, you see a big rise in finance. So that's now people who had hedge funds and other big funds that accumulated a lot of wealth for themselves. And of course, tech industry, that's the names we typically associate with the richest Americans. That's Zuckerberg, Jeff Bezos, Bill Gates, these names. And that has increased quite a bit. But what I want to emphasize here is that often we tend to think about the richest people as just coming out of finance and tech, but there's still a lot of more boring businesses that people seem to make a lot of money with. If you look at production and manufacturing, for instance, that's still a significant share, and that's not decreasing. Retail, the Walmart family, for instance, with important retail innovations that have been able to accumulate a lot of fortunes. The other thing that might be relevant when thinking about the optimal taxation of these individuals is whether they're in fact inheritors of their wealth or whether they are what we call self-made, so first-generation businesses that they founded themselves. And that has shifted quite a bit as well. If you look at these two decompositions from 1982, which is the first year when Forbes created this list, so that's how far back we can go in time. to 2018, you see that indeed in the 80s, it was true that more than half of the people on the Forbes 400 list were inheritors. So there were at least higher second generation businesses or even higher generation businesses. But that has changed too, that now in the most recent year, 2018, almost 70% of the Forbes 400 were self-made. So there were really extremely successful founders who generated a lot of wealth out of deploying their businesses at an incredible scale. Because of globalization, they've been able to grow their wealth at a very fast pace within a lifetime, and some of them are still pretty young. They've been able to become some of the richest people in the US and in the world. Now, the question is, now we've sort of understood a little better who these people are, what is the tax system that they're faced with, and how does it do at this very top of the distribution? And a natural starting point to think about the tax burden that these people are facing is, the statutory top marginal tax rates that they're facing. The most important one, of course, the top individual income tax rate. And this is showing this across all OECD countries from last year, the top marginal income tax rates across countries. And I'm also showing you the top estate tax rates, because that is also an important tax that is overproportionately paid by these very rich people. And you see there's a wide variety of these top marginal tax rates. In the Scandinavian countries, there's a tradition to have a lot of redistribution. So high marginal tax rates in Sweden, 57%. Down to the Eastern European countries that many of them have adopted flat taxes without any progressivity. So for instance, Hungary at the bottom has a 15% flat tax on all income without any progression for higher incomes. And then the estate tax is another important tax because in most countries it tends to be very progressive. So for instance, the US has high maximal rates on estates up to 40%. But then it has big exemption amounts so that most people, in fact, don't pay estate taxes when they pass away. So they're exempt, and only then if you're very rich, the estate tax is supposed to have bite and redistribute the wealth of these big fortunes. The other thing that I'm not showing you here, which is another important tax on the super-rich, is a wealth tax. We here in Switzerland have a wealth tax. It turns out to be a big exception now in international comparison. In the 90s, there were still about a dozen countries that had a wealth tax. Most of them have abolished it. And at this point, there's only 3 countries left that have a wealth tax. It's really only Spain, Switzerland, and Norway. France had a wealth tax, but last year basically reformed it to a tax that only applies to real estate assets. So it's not a general wealth tax anymore. It's just more like a property tax. Italy has exactly the opposite thing. It has a wealth tax that only applies to financial assets, not to other wealth. And then the Netherlands has a kind of capital income tax that is formula-based, so it's a bit similar to a wealth tax, but not really. So I think of really only these 2 countries, Spain, Switzerland, and Norway, that still have one. And out of those, really only Switzerland collects some non-trivial amount of revenue from its wealth tax. It's trivial in the other countries. And the design of the wealth tax in Switzerland is quite different from what is now discussed in the US. It has low thresholds, so not only the super rich are paying wealth taxes in Switzerland, many people are paying wealth tax, very small amounts, and it has very low rates even at the top, so it's way below 1%, even for very high amounts of wealth. Only in the canton of Geneva, I think there is a top marginal wealth tax of 1% for very high income. But otherwise, for instance, here in Zurich, it's always well below 1%. Now, you would think that if you are super rich, so you have very high income, very high wealth, then these maximum statutory tax rates approximate well your actual tax burden, which is your average tax rate. Because if you're well above the threshold where these top marginal tax rates kick in, essentially that's like your average tax rate that you're facing. But it turns out that that's actually not the case. So this is a recent picture from a book that was actually released just last week by Emmanuel Saez and Gabriel Zuckman in the US. And I don't know if you've had the same experience, at least my Twitter tweet has been exploding with discussion about precisely this graph here. And I think that there's been a lot of discussion about what exactly is going on there. So what does this graph show you? It computes the average tax rates in total, and I'm going to say a little bit more about what this means, across income groups in the US. So in the bottom axis you have different percentiles of the income distribution, and it shows the total average tax burden that these different people across the income distribution are bearing. And what they do, in fact, is not just look at personal income taxes that people are paying, but they're also distributing taxes that don't show up on your individual tax return, like, for instance, the corporate income tax. It's paid by corporations, but we know that in the end, only individuals can pay taxes, so you have to allocate the corporate income tax or sales taxes, for instance, to individuals across the income distribution. And what this shows is, if you look at these numbers, it seems that the US had a very progressive tax system in the 1950s with an increasing average tax burden across the distribution, which now has eroded to something that looks basically like a giant flat tax, except that at the very top it becomes even regressive. And I should say here the graph is really exaggerating what's going on at the top, because as you go to these top percentiles, they become smaller and smaller. At the very top, it's just, again, the top 400, the wealthiest 400 Americans. Now, what is going on there? As I already said, and this has received a lot of media attention, and journalists have written about this and have taken this as sort of fact, as pure data that is true. But I should point out, as a public finance economist, that really you should think about this as basically, there's a lot of assumptions behind this. This is not just data, and this is not just a fact. And these assumptions are, I think, contested, to say the least. So just briefly, what are the uncertainty that we have to put around this? Well, first of all, this is 2018 data. Now, I haven't filed my 2018 taxes yet, neither in the US nor in Switzerland. So a lot of people have extensions when they file their taxes. And I think a lot of super-rich have more complicated tax situations. So the tax data from 2018 really isn't there yet. So you have to think about this as really just projections for now. And you should put some confidence intervals around this. The other thing is, as I said already, there is a distribution of taxes that are not showing up on individual tax returns, like sales taxes, and they don't take into account transfers. So for instance, you might ask, why is the tax burden so high at the very bottom of the distribution, even the very poor, like the 0 to 10 percentile? That's because they only look at taxes, they don't look at transfers and tax credits that these people are getting. And these people are paying sales taxes on their consumption, so that leads to maybe an exaggeration of the tax burden of these people down there. Now, at the top, what's going on at the top? Why is it so low at the top? And in fact, the most outrageous part of this graph, I think, at least in social media last week, was that if you look at it, in fact, the billionaires, which is just the top 400, they have the lowest average tax rate across the entire population. So nobody pays less taxes than them, which seems incredibly unfair compared to the huge amount of wealth and income that they have. Now, where is this coming from? And even though I say there are assumptions behind this about the incidence of these different taxes, like the corporate income tax, that is the bread and butter of us public finance economists to figure out what the incidence is, so who really bears the corporate income tax. But it gets quite technical pretty quickly, so I don't want to bore you with this. But just take an example. Think about the richest person in the world, which is Jeff Bezos, the founder of Amazon. What's his income? Well, essentially, he owns, now after his divorce, he owns about 12% of Amazon shares. Used to be 20%, now it's 12%. So what's his income? It's essentially 12% of the profits of Amazon, which is big, that's a lot. But what's the taxes that he's paying on that income? Well, it's corporate income tax. Now, there's discussion about how much corporate income tax Amazon is paying. There's been reports that they don't pay much corporate income tax because they book their profits in tax havens. So, you know, optimistically, we know that the average US corporation is paying about 16% of corporate income tax on their profits. So that would be a 16% tax. So you see that's not much, not a very high tax rate. He would pay individual income taxes only if he sells some of his Amazon shares. Amazon so far doesn't pay any dividends, so he's not getting any dividend income. So the only way to get individual income is selling Amazon shares, in which case he would realize capital gains, essentially. He had these shares for a long time. Now they're worth much more. So he would have to pay taxes on these realized capital gains, and those tax rates on realized capital gains are also pretty low. There are tax at preferential rates in most countries. In Switzerland, there's no capital gains tax, so he wouldn't pay any taxes on that. Another example is Warren Buffett, number 3 on the Forbes 400. He, in 2015, we know that Forbes magazine reported his wealth to be 60 billion. He also released his tax returns for 2015. And it turns out he was very frugal in 2015. He only realized capital gains of 10 million in that year, which relative to his true economic income coming from his wealth of 60 billion, if you think of a macroeconomic rate of return on his wealth of, say, 5%, that would be 5 billion of income that he could realize in principle. But he only realized out of that 10 million, which is ridiculously low compared to his true economic income. So you see that at the very top, there is a problem with our current tax system because some of these very high incomes are not taxed adequately, I think. And that leads, even if it will take a couple of months, you know, to really figure out if these graphs here are accurate, and we might have to change them as we discover more about what exactly the assumptions are behind this. I think the big picture will stand that there has been an erosion of progressivity over time. In Switzerland, do we have a similar issue? So this is an interesting recent paper by colleagues at the University of Basel, Roller and Schmidheiny, that also computes average tax rates across the income distribution in 1975 and 2009 and has that's the most recent year that they have. And you see that according to these measures also average tax rates have come down over time. And there is a little bit of this regressivity also kicking in at the very top. It's a bit different because they only look at federal, municipal and cantonal income taxes, not sales taxes or corporate income taxes. But this regressivity here, I think, is really coming from this tax competition that we have at a very small scale in Switzerland. You know, I only have to move a couple of tram stops outside of Zurich in order to really lower my tax burden. And of course, that's overproportionally exploited by very rich people who make more than 1 million Swiss francs per year. And so because of this sorting, that rich people sort into low tax jurisdictions, and that's relatively easy to do in Switzerland, we do get also a little bit of this regressivity problem at the top. It doesn't come from capital gains here so much because Switzerland doesn't have a capital gains tax, so that those wouldn't even show up on tax returns. Now, we've talked about what the current tax system is. The question is, what should it look like? You know, is there some optimal way to deal with taxes on the super rich? And of course, there's a huge literature on that I don't want to go into the details. I just want to sort of boil it down for you to the basics, which is this simple curve here. When we think about tax policy, and concretely, let's think about the top marginal tax rate. How should we set it on the top income bracket? You know, people in the top income bracket. What you see here is the relationship between the tax rate and the tax revenue that we're getting out of the top income bracket. So, of course, if you start with zero taxes, you're not going to raise any revenue. You raise taxes, revenue is going to go up. But not proportionally, because you know the tax is going to discourage economic activity, people are going to work less, so the tax base is going to shrink as you increase the marginal tax rate up to some point at which you don't raise any additional revenue when you keep increasing the tax. And if you go beyond that, you know, in fact, your revenue is going to decline with further increases in the tax. because your tax base is going to shrink more than what you get in addition through the higher tax rate. If you go to 100% tax rate at the top, then there's no incentives to earn any income above the threshold that where we enter to the top bracket, so the tax base goes down to zero, your tax revenue goes down to zero. Now, I think a natural benchmark for the optimal tax rate at the top is this peak of the Laffer curve, which is what we call the revenue maximizing top marginal tax rate. Certainly, you don't want to go to the right of that peak, beyond the peak, because then you could reduce taxes and get the same revenue as before. So that you could make everybody better off by having lower taxes and still get the same revenue, so that would be inefficient. So that's the maximum you want to go to, so that's why it's a natural benchmark. But perhaps it's also a natural benchmark because you might want to go up to that point if you have redistributive preferences, and that depends on your political preferences for redistribution in the end, to just extract as much revenue as possible from the top earners and use it to redistribute towards people further down the distribution that are less fortunate to get these very high incomes. And so anything to the left of the Laffer curve could also be optimal, depending on your political preferences for redistribution. Now, there is a big chunk of research being done to try to estimate where that peak of the Laffer curve is located. And we now have the tools to estimate that and calibrate that relatively well. And it turns out it depends on two parameters. First, it depends on how much total income there is in the first place in the top bracket. But then also, of course, it depends on the behavioral response of people in the top bracket to increases in the tax rate. If they're very responsive, so if I increase the tax rate a little bit and they reduce their economic activity by a lot in response to that, and we call this the elasticity of the tax base, then I cannot go to very high taxes because then I get very quickly into this downward sloping part of the curve. If they're not very responsive, they just earn their income basically independent of how much the tax is, then I can go, of course, to very high tax rates. And when we take standard estimates of the elasticity of labor supply that people have estimated and the shape of the income distribution of the top, it turns out that you can justify relatively high revenue maximizing top marginal tax rates. 60, 70% is not out of the range, which would be close to the ballpark of what AOC, for instance, is proposing. And in the past, I've written many papers trying to really exactly figuring out which elasticity you need to measure to figure out what the peak of the Laffer curve is, and that leads sometimes to lower numbers than these standard estimates. Now, I think this standard view kind of breaks down at the very top of the distribution. And the first reason I want to talk about here is the role of capital gains at the very top of the distribution. So this is a graph we put together with Joel for this paper, and it shows the share of realized capital gains as a function of your total reported income. So this is called AGI. This is adjusted gross income. Think about that as the gross income that you put on top of your tax return. The share of net capital gains of your total income across the income distribution. And what you see there is that really capital gains don't play any role for most people, up to people who make up to $500,000 per year. It's a negligible share of capital gains, but then it becomes incredibly important at the very top. For people who make more than 10 million, it's already more than half of their total income is just realized capital gains. And for the top 400, it's more than 60% of their income. And I think that's where the super rich are really qualitatively different than most of the rest of the population, like you and me, who have basically labor income. Because if you think about the elasticity, the behavioral response to taxes, it is really not just about how much labor, how much they work in response to tax changes. I don't think that is a relevant margin for these super rich people. They already work a lot, probably. Their behavioral response is more, if there's a tax change, they call up their tax advisor and ask, how do I re-optimize my income structure and my reporting strategy? And so what we call the elasticity of the tax base here is really very directly driven by what we refer to as the plasticity of a taxable income. And by that we mean the ease of converting income across different income categories that are taxed at different rates. So what you want to do as a super rich person is you want to convert income that is taxed at high rates into income that is taxed at lower rates. And I think by far the most important margin for these people is capital gains. Because there's 3 advantages to reporting your income in the form of capital gains relative to labor income. The first, it is taxed at preferential rates, so it's just taxed at a lower rate than the top marginal tax rate for ordinary income. The second is it's taxed only based on realization, so you don't have to pay taxes on accrued capital gains each year when they accrue, but you only pay the tax, after 20 years when you sell your stocks. So that gives you what's called a deferral advantage, an interest advantage that you didn't have to pay these taxes continuously. And then the third and biggest advantage of capital gains is that, at least in the US and many other countries, they completely escape taxation if you never realize them during your lifetime. So if you if Jeff Bezos holds on to his Amazon stocks and never sells them and then bequeaths them to his children, then what happens is what's called step up at death. So that your children then, they never have to pay capital gains taxes on the portion of the gains that occur during your lifetime. When they sell their shares, their capital gains are only computed on the basis of how much they were worth at the time when they inherited them. And we do some calculations in this paper where we estimate that because of that provision, 50 to 60% of capital gains completely escape taxation because they're never realized during the owner's lifetime and therefore never taxed. Now, arguably, most of what shows up as capital gains in these tax returns we think is actually some form of compensation for labor. Let me just give you a little example. When we lived in Silicon Valley, my wife worked for a standard, typical startup company in San Francisco, and the compensation structure in these startups is typically such that you get some salary, but it's not very high because these startups, they don't have a lot of cash. They have to limit their burn rate because they don't have income. So what you get basically is shares in the startup, which at this point are essentially worth 0 because you have no idea whether the startup is going to be successful. So you get these shares, but you don't. Who knows what they are worth? And then you work for a couple of years for this startup, and if it's successful, either there's going to be an exit. The startup is going to be sold to some bigger company at some big capital gain, so then you have to sell your shares and suddenly they're worth a lot, and so you get capital gains and you have to pay taxes on these capital gains. Or you have an IPO, and then again it's going to be worth a lot, so if you sell, you have capital gains. Now if you think about what that really is, it is just the compensation for the labor that she's been doing for these couple of years that she worked for this company. So it is labor income in terms of economics. It's just treated as capital gains in the tax law, but that doesn't mean that it really has much to do with capital per se. And we think that this plasticity of income and this amount of disguised labor income that is now treated as capital income has increased over time. Think about the 50s. If you're a successful inventor, maybe you worked for IBM or another big company that was very innovative. When you patented something, you maybe got a nice salary raise, but it was all labor income, and you earned some returns also for your employer. Nowadays, as an inventor, you're going to have your startup, and your income barely shows up at all in any tax returns unless you have an IPO or you sell your shares or you have an exit. And that also has implications for the concentration of income, because, for instance, in this story, nowadays, the income is much more concentrated with the founder, whereas previously it was sort of distributed across bigger firms that were innovating. So I think that is really one of the problems that we have, and because of this capital gains problem, that's part of the reason why some US politicians, I think, have been thinking about introducing wealth taxes. So I want to conclude with making a couple of remarks about whether we think wealth taxes could be the solution to this issue, to restore progressivity. Now, one thing you have to start with when you think about wealth taxes is what we teach our students in public finance. It's called tax equivalences. So in a standard world, in fact, a wealth tax is very similar to a capital income tax. Just take as an example, suppose we all have a 2% rate of return or 4% rate of return on our wealth. Then a 2% wealth tax is the same thing as a 50% capital income tax. If we just have a 2% rate of return on our wealth, then a 2% wealth tax is like a 100% capital income tax. So in this simple world, really, there is no distinction between capital income taxes and wealth taxes. So given that most countries already have capital income taxes, what might justify having a wealth tax in addition? Well, there's one world in which a wealth tax could make sense, which is when there are heterogeneous returns. So not all of us achieve the same returns on our investments, but some of you guys might be much more successful. Think about that as a world where we're entrepreneurs, and think of the rate of return as some real rate of return to the investments we're making as entrepreneurs. Some entrepreneurs have good ideas, they're very productive, they have high rates of returns, others are less productive. And what you notice then is that a wealth tax in that world corresponds also to heterogeneous equivalent capital income taxes. A 2% wealth tax is, if you have an 8% rate of return on your investment, then a 2% wealth tax is like a 25% capital income tax, pretty low. But if you're pretty unproductive, you only have a 2% rate of return, then the wealth tax is like a 100% capital income tax. So the wealth tax punishes the unproductive entrepreneurs, and it's good for the very productive entrepreneurs compared to a uniform capital income tax. And we estimate that, indeed, if there is significant heterogeneity, that can lead to significant efficiency gains, because the wealth tax would encourage the reallocation of capital from unproductive to productive entrepreneurs. On the other hand, and unfortunately there's always an on the other hand in economics, if these heterogeneous returns come from something like heterogeneous rents or markups or windfall gains or excess profits, then we know that it is efficient to tax those rents away. And the wealth tax gets that exactly reversed, because what the wealth tax does, it taxes the normal, what we call the normal rate of return. It doesn't touch these excess rents. So think about, again, an example where we all have a real rate of return of 2% on our investments, but some of us are monopolists, so we can charge higher prices because we have some power to set markups, and that's why we earn an additional excess profit, excess rate of return above these 2%. Then a 2% wealth tax is not going to touch these excess profits. It only taxes the original true 2%, the normal return, whereas a capital income tax would touch, of course, tax away some of these rents. And I think the evidence recently, and that's a sort of, we need more evidence on that, clearly. We are sort of at the beginning of figuring out where this rate of return heterogeneity is coming from. But my reading of the recent evidence is that there is quite, quantitatively, probably this heterogeneous rent story is dominating this. Because, we have a lot of evidence on rising markups, rising market power. The reason why Amazon is worth so much is not really because of the computers they own and the rate of return that they achieve on their investments. I think it's partly because people believe that they have a lot of market power and they will remain in a dominant position for a long time, and that's what gets then discounted back into the current valuation of these companies. And if that's the case, then actually a wealth tax, because it corresponds to a unit tax on the rate of return rather than a proportional tax, is actually not very efficient. And I think, quantitatively, I think that is an important concern about a wealth tax. So I think there are alternatives, and we discussed some of them in our paper with Joel. We already identified the problem as coming from capital gains. That's the root of the erosion of progressivity, we think. So I think a natural way to target that would be to just fix the problems that we have currently with how we tax capital gains. So for sure, we should get rid of the step up at death, because that allows a lot of capital gains to completely escape taxation. We should tax capital gains at higher rates, I think, to restore progressivity. And we might also think about changing the system from a realization-based tax to one based on accrual. I don't think the interest rate advantage is so big right now when interest rates are essentially zero, so you don't gain much from deferring your tax burden. But in times when interest rates are higher, then that again would be a big advantage that we have to think about. And then the other thing I think is the estate tax, because to me the estate tax is a really important tax, also from the perspective of, equality of opportunity and meritocracy, that we redistribute things when people pass away, preferably even an inheritance tax. Unfortunately, the estate tax has been unpopular in many countries. Many countries have reduced their estate taxes or abolished them. In Switzerland, it barely exists anymore for direct descendants. It's been abolished by most cantons. But I think that's a bit puzzling because, really I think the estate tax is the way to deal with the rise in wealth inequality over the long horizon across generations. So to conclude, what I want to convey here is that when you think about taxation of the super rich, you shouldn't just look at tax rates, what's the right tax rate on these people, but you have to think carefully about the non-rate tax instruments that you have available, which is how you design the tax base and, of course, also how you enforce it. If you allow for a loophole through capital gains taxation that is completely legal to be exploited, then, of course, this will be exploited by the very rich people, and that will reduce the tax burden that they're bearing. But that's a policy choice. We could fix that. And that's not directly a question of the right tax rate. It is really a question of how to design the tax base, which will affect the elasticity and the plasticity of taxable income of these people. So again, you shouldn't think about the behavioral response of people as a fixed structural parameter that is just a force of nature that we have to accept. The elasticity is a function of how you design the tax base, and so you can think about also optimizing the elasticity that you want to have. And similarly, I think of tax evasion and, in fact, also tax competition as policy choices, how much of that we want to have. Again, those are not forces of nature, and especially within a country where you can actually do things about it. But even at the international level, we've seen a lot of efforts recently at coordination of tax policy across countries that we didn't think would be possible for a long time. If you just think about the data exchange that we now have, the US pushed for this to get the data on all the foreign accounts held by US tax residents. It used to be thought that this is impossible to get. The US pushed for it. Now it exists, and I think it will affect the amount of evasion that is possible to happen. Similarly, with tax competition, there are now efforts by the OECD and other agencies to coordinate the corporate taxation of multinational firms that I think will be successful in the medium run, and that will also have effects on how much tax competition we will continue to see. So I think we have the tools to restore the progressivity of taxes at the very top. And I want to just conclude with emphasizing that I think this is really immensely important to get these analysis right here. Because the stakes are very high. It's about a lot of money, and there's a lot of potential tax revenue there. And I think the issue of inequality is really important. I think a growing share of our society cares deeply about it, especially among the younger people, is my sense. But we cannot form policy without a precise understanding of where these inequality trends are coming from and what the effects of taxes are. And what I'm trying to do with some of my work here is to, inject a little bit of scientific objectivity into this public debate about taxation and the super rich.